Welcome to vacationlore.com, your source for tools and tips for managing your vacation rentals. In this video, we're going to talk about how to file your tax return for your vacation rental property. Now, we're going to make a few assumptions, and the assumptions we're going to make are for the most common filing status. So if you have a vacation property and you don't know how to file your taxes for your property, it's very likely that you're going to file using this status, as we will discuss, and that status is called active participation. This is the most common filing status. Simply put, you are renting the property as a side job. You have another major source of income. It could be investment income, it could be you're working at a job, and also you're going to file your property on your personal return using Schedule E. The second assumption we make is that you own the property 100% and that you rent it 100%, meaning that you did not have significant personal use of the property during the year. So let's get started. Before we get started, I'd like to refer you to a very useful spreadsheet and article that goes along with this video. This spreadsheet and article will give you instructions on how to tabulate all your income and expenses into the appropriate categories prior to filing your tax return. This will be very useful to you because when you have all your financials summed and tabulated in the appropriate buckets, putting together the information in your tax return is relatively straightforward. You just take the information directly from the spreadsheet. So now and this is what the spreadsheet looks like right here. This will tabulate all of your income and expenses, and all you need to do is refer to the spreadsheet as we go along in this video. So let's get back to our main program. So you're in your H&R Block software, and in this we are using the deluxe version of H&R Block software, which is perfectly adequate for what we need to do. So the first thing we're going to do is to go to the rentals and royalties section. Now, normally you would add an activity to specify a single property that you're renting. Now, I've already entered a property here, so for ease of explanation, I'm just going to edit one that's already created. And in the very first piece of information you need to enter your property is the address, and also specify it as a type 3. That says that it's a vacation or short-term rental. Also, for our purposes, we're assuming that you owned it throughout the year and that you're renting it 100%. Now below here, there's many different kinds of checkboxes that are special situations. We won't go into those here. We'll cover those in later videos. And also another one of our main assumptions is you do not have any personal use of the property. So again, we're going to say no for that. Now, about days owned and rented. So again, we're going to use the 365 because that means that you owned it as a rental the entire year, and you need to count up all the days that you actually rented the property. And the last is days offered but not rented. So these could include days that you actually put the property up for rent but it was not rented, in addition to days where you realistically have no possibility of renting the property. Now, in terms of tabulating your income, from the IRS point of view, income comes from two places. The first is income actually tabulated in what's called a 1099 MISC. This is a form that a management company, a real estate broker, or others might send you that tells you what your income was that they charged throughout the year for your rentals. So if you get one of these, you definitely want to enter that information here because the IRS will look for that form to match up with the numbers that you put into here. So if you had $40,000 in rent from a real estate broker, the IRS is going to look for that number that matches the form that the broker also sent to the IRS. Now, another thing to note about this is everything else, marketplace revenue, your own personal rentals, they'll be tabulated in the next screen as we'll get into. So you want to say yes to this. So that's the end of for that. So you do one of these for each of your 1099s that you got. Now here, tell us about the rent you received. Now this is for tabulating all other rent. This could be Airbnb, this could be HomeAway, this could be someone you rented the property to someone, to a friend at the market rate, and anything that's not specified in a 1099 would go here, and you would put it in here, all other payments. So whatever income you got from all of those sources, you would put here. Now, in terms of depreciation, depreciation is a topic in and of itself, but for this introductory video, we're just going to talk about the depreciation of the property itself. And here, we're going to call this the main property, date and place of service, rental use should be 100% under our scenario, and you're going to specify residential real estate. So this is the depreciation that you enter for the property itself. Now, for your numbers, you need two numbers. You need the price you paid for the property, as well as the value of the land. Now, in the article that we talked about previously that's linked into this article, we talk a little bit more about how to determine what this number is, but a good rule of thumb is that land is approximately 20 or 25% of the property value. Depreciation summary based on that is $13,000, and you can depreciate it for 28 years, including the current year. Now, if you used a vehicle in the servicing of your property, you can deduct an expense for that. Now, we recommend, under this scenario, the most common case for this is you are using your own personal vehicle to service your rental property. It could be 10%, it could be 5%. So just enter here the name for the car, date you placed it in service, which would be the same date that you bought the rental property, as well as the number of months that you used it for travel. Specify where you own or lease. And these are other things that are unusual. You might want to say personal vehicle started for using, if you did it in 2019, that would be as if you actually bought the property in 2019. But if you've, in subsequent years, these things would all be special cases that you might want to check. Now, total miles driven. The most important number is miles driven for business. That's the number that you used for servicing your rental. And these are just other numbers that are meant to fill out the form. Total miles driven and commuting miles. Now, because you're using a personal vehicle, we suggest you keep it really simple. Don't tabulate your expenses. Take the standard mileage deduction, in this case, which is 58 cents per mile. Now, another important detail here, that standard mileage deduction will cover your interest on car loans, personal property taxes. However, if you have garage rent or tolls, those would be deductible in addition to the standard mileage deduction. So if you have these expenses, be sure to specify them here. And here are some other information about your car. We suggest you check vehicle available for personal use. That's typically your case. And also have written evidence supporting your deduction. Now, here's where tabulating all your rental expenses. Again, the spreadsheet that we talked about in the article will be very helpful for filling out this part of the form. Let's just review these very quickly as far as what each of these are. Advertising. This is expenses for web hosting, Google Ads, or other kinds of promotions. Cleaning and maintenance is self-explanatory. Commissions are fees that you pay on a per rental basis. Insurance is your property insurance. Management fees would be fees that you pay to either manage the property or obtain rentals that are generally fixed price kinds of fees. Property real estate tax. Next is repairs and supplies, which are relatively self-explanatory, and also taxes. Now, in this case, the taxes would be for sales or use taxes that are required in your jurisdiction that you personally had to pay, and not a third party like a realtor may have paid these on your behalf. But if you yourself got rentals, and you might be responsible for charging sales tax, so that you would put that in this box here. And the last one is utilities. Now, mortgage interest and points. Now, if you have a mortgage on your property, you would specify it here. So, for example, let's say it was $5,000. Now, this other mortgage interest and points is very important because it very well could be if you obtained a mortgage upon closing of your property, there might be mortgage interest in your closing documents. So if there was, you'd want to specify it here as well. And if you did have any points, you would specify that in the points box because points are deductible on your tax return as an expense. Now there's boxes here for other kinds of expenses. Here I just made an assumption that maybe you have a condominium and there's association fees. This $1,000 would include what you paid during the year, as well as what if there were any in your closing documents. And there you are. There's how you tabulate it. There's everything all up in one summary. And because you owned it 100% and you rented it 100%, you will get the full deduction for all the expenses. Now, rental loss. This is a topic in and of itself, but we're going to take the shortcut here and tell you what you need to know. Now, was your average lease 7 days or less? This very well could be true for you, particularly with the modern marketplaces that are available. But in any case, if that is true, they're going to ask if did you materially participate. The answer is no, because we're doing active participation. And then if you answered no, what you would get, you'd get a box for, do you qualify as a real estate professional? Again, the answer to that is no as well. Here's the key question here. Did you actively participate in the rental? This is the filing status that we're doing in this video. And what this means is that you own the property and you actively took part in managing the rentals. And you may have, it very well could be that you paid someone else to do all of the tasks. But if you're actually managing it from that point of view of, and it's not part of a partnership where other people take care of it, you have to manage it. If that's true, then you say yes. Now, if you have losses, if once you own the property for a few years, it very well could be you have losses from your rental activity. If that's the case, you make sure you want to check this box so that they get carried over. Now this is the first year, so there's nothing carried over. And now you might say, well, I'm making money. How could I have a loss? Well, what would happen with the loss is due to your depreciation which is a non-cash charge, that will typically put you over the edge into, or from an accounting point of view, your property is losing money. From a cash flow point of view, it could be different. And there you have it. You've just completed your first Schedule E for your vacation rental property. If you have any questions about anything that's specific to your situation, we have many more articles and videos coming up. But if you need something immediately, feel free to contact us either in our About Us page or in the comments below, and we'll be sure to answer your question. Thanks for watching.